All right, good afternoon. This is Chair French convening a special virtual workshop session of the Kansas Corporation Commission set for today, January 14th, 2025 at 2 p.m. Our topic today is Investor Perspectives on Natural Gas Utilities, a Canadian and United States review for 2024. And our presenter is Mr. Juan Alvarado, Managing Director of Energy Analysis from the American Gas Association. Juan, I don't believe any of us have any introductory comments, so I am going to turn it directly to you with your presentation. And I don't know if our IT staff has your presentation or if you will just be sharing it directly.
I've been informed that you guys will be sharing the presentation for me.
Great. Go ahead, Sean. I'll let you show.
Okay. Which one is it? Is it the investor perspectives?
Yes.
Okay. Give me 1 second and I will get that going.
Perfect. Thank you. So anyway, good afternoon, everyone. As Chair French said, my name is Juan Alvarado. I am the Managing Director of Energy Analysis at the Association. Generally, that's a lot of words to say that I am the economist. My focus is on economics. I'm an economist by trade. Prior to being here at the association, I spent 15 years being director of all kinds of things at the Maryland Public Service Commission. I was director of telecommunications. I was director of water. I was director of gas. Briefly, I was director of electricity. And then finally, I was director of economic analysis. So I did all of it at the Maryland Public Service Commission. I've also spent here about 7 years as a instructor and lecturer at Nehru Kuwait School, specifically on cost of capital issues. That's where I cut my teeth. I am cost of capital is where I started. I am a certified rate of return analyst. And so when someone asked me to talk about investor perspectives and ROEs and cost of capital, this is my playground. This is what I really, really love to do. I know that it sounds geeky and for some people it might sound awful, but for me, this is an absolute pleasure to be here. So thank you so much for inviting me. Let's see if I can make some of this kind of exciting. So anyway, if you can go to the next slide, this is just kind of introducing who the American Gas Association is. We really represent the LDCs around the country, which ultimately offer gas service. Our members offer gas service to roughly 98 and 95% of all end users in the United States right now. We do not represent producers. We do not represent transmission. We do not represent any of that. We represent exclusively the local utilities that serve us and those that are under the direct jurisdiction of the KCC would certainly fit under that bill. Next slide, please. So I want to start by telling a story of my first couple of weeks here at the American Gas Association. I started at the association back in 2020. It was full virtual kind of introduction to me because of the pandemic. And basically on my first day, my supervisor, Richard Meyer, said to me, here's a bunch of stuff that you're going to work on. And also tell us one thing that you would like to work on. Tell us one thing that would be of interest to you. Now, as a former witness in rate cases, specifically in cost of capital, one of the things that we always did was, as we did this analysis, was to sit there and kind of talk to ourselves and think through what do investors want? And I did that for 15 years. And over the course of that time, I always ask myself, why has nobody asked investors what they want? Why doesn't anyone just go up to the investors and be like, hey, you know, what's of interest to you? What are you thinking? it was intriguing to me that nobody actually did that. And so when I got to the association, I said, here's something that I'm interested in. I want to know how investors perceive regulatory decisions, specifically on ROE, but generally regulatory decisions. Since this is the gas association, I will focus on gas utilities. But generally, I wanted to know how investors think through how ROEs are set and all of these things. So back then, we engaged the Guidehouse. And when I say we, I mean the American Gas Association in conjunction with the Canadian Gas Association. And we asked them to answer a few core questions, right? First of all, we wanted to paint a landscape of how ROEs are set nationwide. Generally my discussion is going to be nationwide. I don't know, and I won't be able to share with you many regional insights. This is generally nationwide. Do investors believe that the way ROEs are set in North America are consistent with their own expectations? And how do we ensure that going forward, investors find us attractive so that they can continue to provide the capital that's necessary to kind of do all the things that we are being asked to do ever so increasingly? In order to answer those questions, we issued this report. It was done it was separated into two sections. The first section was some foundational research. It really just took a snapshot of what kind of ROE decisions looked like back in 2022. And then we went out and we interviewed investors and we asked them directly their thoughts on ROEs. Back then, interviews, we thought that the independence of the interview process was going to be paramount. So we reached out to Ipsos and they conducted these interviews on our behalf. Thinking back on it, there are pros and cons to our approach. I think at the time, kind of the cons outweighed the pros. One of the big issues is that whoever conducted these interviews by Ipsos wasn't really super knowledgeable about the energy sector. And so follow-up questions tended to be kind of muted. It was very hard to kind of engage in a conversation. Nonetheless, if you go on to the next slide, we did get some really, really interesting conclusions from this report. Now, there's a lot of them. Right now, I want to focus on these two specifically. One of the more important ones is that investors really told us that they want consistent year-over-year rate-setting methodologies and hopefully consistent returns being applied to us. Now, time for another little story of mine. When we released this study, I attended, like I always do, the SURFA. This is the Society of Utility and Regulatory Financial Analysts conference. At the time, it was in Richmond, Virginia. This conference is attended by investors. It's attended by all the cost of capital witnesses, many of whom I'm sure provide testimony before the Kansas Corporation Commission. These are attended by our members and they're attended by commissioners. And the first question that was asked by one staff member from a state that will remain nameless was, why do we do this at all? Right? If you go to investors and you ask them what they want, almost invariably what they're going to tell you is that they want more money. And so, I said, thank you for that question. Actually, the person who asked the question was my friend. So I felt pretty comfortable with him. I said, thank you for the question. It was very clear that you did not read the report and I encourage you to do so because that conclusion that you insist has to be the case was not the conclusion that we reached from these interviews, right? What investors want is to be certain of their investment when it comes to utilities. When I teach rate school, we look at betas. Betas for utilities are always very, very low. They tend to be in the 0.6 to 0.7 range on average. They're very safe investments from a utility perspective, and they want to continue to the investors want those to continue to be safe and kind of consistent investments because that's what they use investor capital or investments into the utilities to ensure that their portfolios are the risk in their portfolio is adequately balanced and all these things. So that was very interesting that we heard it directly from the investors. Certainly we want an ROE that allows us to attract the right capital at the right time and at the right price. But we also want an ROE that is consistent. We would rather have consistently year after year. We know that we're going to get a 9.6, 9.7 or whatever, and that the policies that are in place by this commission, whichever commission it is, are conducive to us being able to recover that ROE fairly predictably, rather than having a commission that gives us an 11% ROE one year, and then the next year gives us an 8%, and then maybe we earn a small proportion of that ROE, but we don't know, and maybe we do earn more than we expected, but we still don't know. That's not what they're looking for when it comes to investment in utilities. And so that was one of the biggest takeaways. Just to say that in the follow-up report, many of those same themes crept up. The other kind of outcome was that the investors were really looking for innovative frameworks in order to reduce that volatility when it came to not only the ROE that was being set, but also their ability to recover that ROE. And so, for example, they repeatedly cited, forecasted types of test years, hybrid types test years. They cited states that had, for example, formula rates that were looking into the future. They repeatedly cited decoupling, stuff like that allows them to more effectively recover their allowed return. So that was one of the things that they repeatedly cited. Now, for me, that was actually pretty telling, because investors also said repeatedly that they don't want to be involved in the rate setting process, right? They don't want to be in the nitty gritty when it comes to rate setting. They want kind of the utility to run its business, to deal with its regulators in a constructive way, and then for them to be able to get the returns that they need. Of course, if they don't want to be involved in the nitty gritty, it was very exciting for me to know that they were thinking about things like the type of test year that was being used in a particular state, or the type of mechanisms that were being approved or disapproved in a particular state. So we'll talk a little bit more about that as this goes on, but I thought that was very, very interesting from the 2022 study. Just so that you know, that 2022 study is available for you to read, just like the 2024 study. You might want to look into it. Obviously, the 2024 study is now updated, and I'm going to be presenting that now. So if we can move on to the next slide, please. Okay, so investor perspectives. This is what we called the most recent study. Now, we thought that Guidehouse did an excellent job of being a partner in developing the initial report. But one of the things that attracted us to MCR Performance Solutions, which is almost a boutique consulting firm, is that they and their staff had a couple of former investors who were really working in the utility space throughout their careers. Specifically, Sam Brothwell, for those of you who are knowledgeable about the investment community, and specifically the investment community surrounding utility investments, Sam Brothwell has been around for many, many years. He's very knowledgeable. He also has all the right contacts, right, within Wall Street. And so we thought, and it turns out we were correct in our assessment, that he would give us the best opportunity to engage, interview, and talk to all of the right people that we needed to talk to for this report. Much like the 2022 report, this report also includes some foundational research. It's really updated and a little bit of expansion to it. And then the investor interviews, unlike in 2022, when we just asked Ipsos to conduct the interviews, this time they were conducted directly by Sam Brothwell, recorded, not for they're not allowed to be divulged to anyone. These were all under strict confidentiality, but we wanted to make sure that we weren't, that whatever we put into the report was correct and accurate. And that led to some really good results because it led to our ability to have like real conversations with these investors, right? To ask follow-up questions, to ask clarification questions. And so our insights this time around were, we had more insights and they were, I guess, a little bit more in depth. So that was really exciting for us. Next slide, please. So let's talk a little bit about the foundational research. You're going to see in a bit a chart where I show where ROEs have been headed over the last couple of couple of decades. Now, I'm fairly certain that that you probably have seen a version of that chart before. We see ROEs trending downwards over 20 years or so in time. And there were several reasons why that might be true. But one of the interesting things that we saw is that if you take the last little bit of that trend line and you look at it closely, you can see that ROEs are starting to trend up. And when you really look at why, the most direct, and there's many reasons, interest rates are going up and, there's been a little bit more investment, a little bit more risk associated with the utility business over the past few years. Not a lot, but a little bit of more risk. And so that has resulted in higher ROEs. But really, it's the higher yields that have led to that resurgence in ROEs over the past few years. Obviously, the pandemic had a little bit to do with that as well. The effects of it are, believe it or not, still being felt in the financial community in some regards in terms of interest rates and inflation and things like that. And so this has led to ROEs trending up. And I'll show you that in a second. Historically, however, investors have ascribed less regulatory risk to natural gas utilities vis-a-vis electric utilities, right? So we're talking about the how to compare the two. There were many reasons cited what that might be true. For example, or operational risk, right? Natural gas utilities are generally underground, and so they are less prone to things like hurricanes or fires or things like that. Whereas electric utilities tend to be above ground, and so there's a little bit of an additional operational risk there. There's also the idea of the gas commodity markets being a little bit more stable over time. The idea that there's also plenty of natural gas available in the United States, and therefore natural gas tends to be cheaper, making some of that risk a little bit less marked than on the electric side. Things like that. These are things that have been cited by people who look at risk specifically as to why historically natural gas utilities have been less risky. But what I'm going to show you in a second in that same graph is that difference in risk as it's reflected in the allowed ROEs across the country, that has narrowed to the point where it's almost impossible to tell the difference between where natural gas ROEs lie today versus electric ROEs. And you'll see that in the graph as well. The other...
Mr. Alvarado, could I ask a question?
Absolutely.
Maybe I'm restating what you said another way. But one reason I've always, I guess, thought of the difference between the LDC and the electric business from a risk perspective is that the LDCs, at least in our part of the country, they're basically just in the delivery business. They're not producing the gas. They're basically buying it. They're a middleman, and they're delivering it. And so their business, what they earn a return on, is just the delivery piece. It's not that the production, which tends to be the more volatile piece. Customers still experience that, but it's not subject to the ROE. We're obviously on the electric side, we have vertically integrated utilities that have generation assets that are exposed to all that market volatility. Is that kind of what you're saying, or is that an additional way to think about the risk that may apply between those two industries?
Yeah, so I was giving a few examples of why one might be it, but that's another example. Of course, not every state is vertically integrated. And so when you look at national numbers, vertical integration tends to not be as much of a driver because there's a lot of states who are not vertically integrated. nowadays. So, but yeah, certainly another good example specifically for Kansas that this is true that electric utilities are vertically integrated. And so when you're going into things like building nuclear power plants like Georgia did, that's going to affect your ROE, right? That's going to have an effect. Whether it's positive or negative is up for debate, but it's certainly going to affect it. Now, we also looked at some of the other reasons why, and one of the ones that again was cited repeatedly were these alternative recovery mechanisms, right? Now, really, what these are meant to do is to reduce the regulatory lag. How you measure regulatory lag? Well, that's up for debate. But one way to measure it is the difference between the earned versus the allowed return, right? And so when you look at that difference between the earned versus the allowed, I think everyone agrees that it's virtually impossible to fully eliminate. There's timing issues, there's communication issues, there's data issues. But I think everyone would also agree that if you're going to allow for a return to be earned, that you should give the utility the best ability to earn that with the best tools. And I think investors recognize that, and they identified some of the ways in which you can do this. Now, this actually makes it very hard to compare risk across jurisdictions because, of course, what lowers your risk more? Is it going to be a forward-looking rate or a tracker? Well, I frankly don't know, and I don't know that it's super easy to quantify. It's really a combination of things. So when it comes to which state is riskier than the other, I think what you really have to look at is, there's a feel that investors have, right? There's a feel that some jurisdictions might be more constructive, moving in the right direction versus moving in the opposite direction. So I know that all about, for example, RRA ratings. You see some states that have very low RRA ratings, but might have, for example, forward-looking rates. Now, if you look at why those states might have low RRA ratings, generally there's a lot of discussion around those states about getting rid of those forward-looking rates, right? There's some states that don't have a lot of forward-looking rates, but they might have a lot of riders. And we measure that as a percentage of rate base. So how much of your rate base you're recovering through riders. Certain states, particularly in the Mid-Atlantic, have a lot of riders. And so they tend to be seen a little bit more favorably, things like that. With the advent of obviously big events like certainly Winter Storm Uri, the hurricanes that come by, securitization is a big deal in many states. And so we're seeing discussions of securitization and how effective the use of that tool has been. That has been changing the perception of risk over time very clearly. And this is what investors are looking at as they decide where to put their money. Next slide, please. So let's look at the microeconomic trends as to why the foundational research looks the way it does. Well, to be clear, inflation grew tremendously since 2020, right? Since the pandemic, inflation, and you can see it here, from 2015 to 2020, the inflation rates were not only low, but they were pretty stable, right? And then the pandemic hit and inflationary pressures started to change. And then you see not only that inflation went up and it reached as high as 6.6%, and this core inflation, of course, on the third quarter of 2022. But also, if you look at this more closely, and I know that I don't have the numbers here, but you can measure this. You can see how volatile this became, right? This trend became. It was very volatile, and it was hard to know where inflation was going to go. So in that context, in a context in which you know that inflation is going to go up, but you don't know by how much. And if it starts to go down, you don't know if that reduction is going to be there to stay or it's going to go back up. And if it's going to go back up, if it's going to go back higher to where it was before. It was increasingly challenging for the utilities to be able to maintain that safe, affordable, reliable, clean energy, while also maintaining the financial integrity of the utility. And so that has intensified some of the, for example, when we see how the ROEs and the risk for gas utilities start to catch up with electric utilities, that's because that part of risk has become a bigger portion of the portfolio of risk that the utility manages. And so it is seen a little bit as a bigger kind of descriptor of what the specific utility's risk profile looks like. And inflation has something to do with that. Obviously, with inflation, we also saw interest rates go up, which have an effect on your ROE and your ability to recover it. So this is where we stand right now. Next slide, please. Talked about interest rates. Here's where we are with interest rates, right? Interest rates go up as well. As you calculate your ROE, obviously you use very different types of methodologies, whether it's a DCF, a CAPM, or anything else that you can imagine. The SERFA guide lists something like 27 different methodologies. I've only really seen like 4 or 5 used repeatedly, but there's all kinds of methodologies, of which a good chunk of them are very much driven by interest rates. The biggest one of them being obviously CAPM, but these are very driven by interest rates. So as interest rates go up, you also start to see, or you would expect to see, the ROE to go up a little bit as well. I don't recall right off the top of my head if I added a slide that I wanted to add into this presentation, but if we don't, I'll go back and talk about some of what this means in terms of regulatory lag as well a little bit later. Next slide, please. So actually, this is really important. I was presenting this study at NARUC, and actually I got a commissioner who was very confused about why I kept talking about the idea that commissions do not set the cost of capital, right? And she said, well, if I set the ROE and I set the capital structure, aren't I setting the cost of capital? And, you know, I said, I understand where you're coming from, Commissioner. I was a cost of capital witness. And as a cost of capital witness, in theory, what you would assume is that you're setting the cost of capital, right, for the utility. But in reality, what you're really setting is an allowed rate of return, right? The cost of capital is not set by the regulator. The cost of capital is set by the market. And the regulator really has very little incidence into the cost of capital, other than if a regulator starts, for example, sending signals that are scary to investors, they might require a higher return, right, in order to invest in a specific utility. Or obviously, if the regulator starts sending signals that make the investors happier, then that might reduce the cost of capital a little bit. So certainly there's a symbiosis there, but in practice, we're not really setting the cost of capital, right? The cost of capital, the cost of debt, and the cost of equity are really set by the financial markets, and we are only setting the ROR. Now, there's also a difference in the way the allowed rate of return and cost of capital are determined, right? The witnesses that stand before you and tell you about the cost of capital, what they do is and you know this, but I'll just go over it real quick, right? What they'll do is they'll collect a bunch of data and they'll throw it into their models, whatever those may be, and then they'll make some very important decisions about where they're going to go with that data, because the data is not precise. We use proxy groups, for example, whereas we don't have specific data on what equity investors might want. We might be using lagged data in some instances. We can't have it up to date all the time on the spot, right? So we are building the allowed ROR from the bottom up. But that's not how investors look at where to invest their money, right? For them, they use a top-down process, right? What they will look at is they'll look at their portfolio, they'll look at their investment strategy, and they'll look at where they want to be with regards to risk. And then they will invest in assets that will get them to whatever risk profile they want to be at, right? So, for example, if they've invested in what they consider to be relatively high yield but high risk investments, then they might balance that with lower yield but also lower risk investments. And some investments might be high yield and low risk, and those are the investments that you really want your money in. And some investments might be high risk and low yield, and then you want your money out of there. And so, in states, for example, where you see decisions that are making the operations of the business difficult, and where RORs are low, you actually can see this in real time happening. And I'm not going to throw any commission under the bus, but I will mention two examples. About 4 years ago, a commission reduced a utility's ROE by 100 basis points. Now, this was accompanied by a number of other decisions that were also not very good for the utility. This was an electric utility, by the way, right? Now, when this order came out, I was sitting at the SERFA conference, literally right next to a Bank of America investor who I knew had assets in Arizona specifically. And I said to him, like, if you're sitting in Arizona and you see this happening, what do you do? Do you leave your investments in the state that's making these decisions, or do you move them to Arizona? And he said, it doesn't really matter. I can move them to Arizona or New Mexico or to whomever. But at the end of the day, it took me 15 minutes to pull my money from this state and move it into either Arizona or New Mexico or wherever, right? And so investors, I don't think commissions and commissioners specifically realize that investors are looking at their decisions and that they're acting on the decisions that they make. I'll give you another example. Recently, another commission made a decision that dropped the ROE of a water utility by about 120 basis points. The water utility promised to leave the state. They put themselves up for sale, and a year and a half later have been unable to sell their system because nobody wants to invest into that specific state because of the regulatory environment. So you see this in real time, right? You see how a commission might make a decision that that people deem to be contrary to the best interests of their investments, and then the money is pulled. Now, it also works the other way around. We've seen some states, again, not going to mention any names, but we've seen some states, for example, allow some very good investments into, for example, the updating the energy grid recently, right? And those were very healthy investments that really resulted in a bunch of investors pouring their money into that state. So we see this in real time. And I like this slide, and I like what we talked about investors here, because they told us we're looking. We might not be involved, but we're looking. Now, this is a change from a number of years back, and I should have mentioned this up front, right? One of my mentors and one of my best friends is former chair of the Illinois Commission. He's now a very well-known professor of economics, very deeply involved in utility regulatory issues. And he used to tell me, back when I was a chair in the 1980s, we used to get investors in the rate case filing testimony and testifying before us. Now, that's unheard of today, right? You wouldn't imagine an investor showing up at the Kansas Corporation Commission being like, I want to testify as to why you should give this ROE or whatever. That's unheard of, right? So I think it's important to keep in mind that, because that doesn't happen anymore. Investors, as a stakeholder in these rate cases, have to, we have to keep in mind what their needs and their appreciation for our decisions are. All right, next slide. Now let's talk about a little bit of opportunity cost of capital. This is going back to, I actually teach this slide at rate school, right? First day of rate school, first lecture that I give on Monday at rate school, I talk about the opportunity cost of capital. And it really is how investors make decisions, right? They look at the risk and the return factor in a utility, and then they decide whether their money would be better invested somewhere else, right? And where could it be better invested if not in that utility? Well, if they can see a investment that has a similar return but a lower risk profile, for example, they might decide to go in that direction. Or if they see something with a similar risk profile, but with a higher return, they might go in that direction, right? We tend to think of utilities as regulated monopolies, and therefore they're not competing. And that's true in the sense that they're not competing for customers, but they are competing for money. They're competing in the market for investment. And when they compete for investment, if you're in a state, let's say I work for Maryland, I lived in Maryland. If I work in a state like Maryland and our risk is similar to, let's say, Pennsylvania's, but we're offering a substantially lower ROE in Maryland, then investors might decide to move over to Pennsylvania. And the other way around, it also works, right? If they perceive that we're awarding similar returns in Pennsylvania and Maryland, but Maryland, for whatever reason, they perceive as riskier, they again might go over to Pennsylvania and decide to invest over there. So it's important to keep the opportunity cost of capital, because as one investor very clearly put it, he said, "We vote with our feet. We might not vote officially any other way, but we vote with our feet. If we don't like what we're seeing, we're going to pull out." Chair French.
Yeah, so obviously have some reaction to this, and I'm struggling with how I asked the question, but this slide is really set up to suggest that investor reactions are very elastic, and as these decisions are made, people enter and exit positions, and I think there's an implication here that a utility's capital needs sort of almost immediately may not be met if, depending on a decision and somebody exits a position. I mean, in my experience, I know about specific situations, even in our state, where we've made decisions and investors have directly told us after the fact they exited their positions. But of course, others have welcomed that opportunity to fill that capital hole. So I guess what I struggle with here is just how much, while I agree with all of this in theory, how we put this into practice in a pragmatic way. I mean, what I said this on a previous workshop. We're trying to estimate the minimum return to induce investors to commit their capital to the utility in question. We're trying to estimate that number, the required rate of return. We haven't really seen a point at which our utilities, at least, have failed to attract capital. And so I guess I'm struggling with what guidance, is it the possibility of an ROE going too low? Is it maybe bigger policy issues, things like natural gas bans? I mean, what are the big triggers that you think might eventually get a utility to the point of having truly inability to attract the necessary capital? What are those triggers? Because it doesn't seem quite as elastic to me, maybe as it's set up in this slide.
Well, I think, so to be clear, when you're talking about elasticity, what you're really talking about is how quickly investors leave a state, right?
Yeah, and the magnitude, even if one leaves, is it all of the capital flowing out, or do the markets have the ability to pick that up? And under what circumstances are the markets unwilling to fill that spot up?
Yeah, I think generally, when we've seen actual investor flight, right? Those have been very, very pronounced decisions by a commission, right? Very, very pronounced decisions. Now, I don't know the history of Kansas. I don't know any of the decisions that you've made.
We're pretty boring.
I've been there, and I beg to disagree. But I don't know what decisions you've made, but these are decisions that make national news, right? Maybe not on CNN, but certainly in Public Utilities Fortnightly or utility dive, right, you'll see, wow, this is what happened here right now. So investor flight is not something that should necessarily concern you unless that's the direction you're going. But what you do need to be concerned about is the cost that investors are going to expect if they decide to stay, right? So yes, you might make decisions and people won't leave, but they will be asking for higher and higher returns in return, right? Over time. And this is one of the issues that you run into is that, you're balancing that idea of affordability with the appropriate return for I wouldn't characterize it as the lowest or the minimum as you did, but I would say that it's got to be appropriate, right? And when we say appropriate, I mean, it's got to be appropriate for the end user, it's got to be appropriate for the utility, and by extension for the investor. So when you're balancing that, right, you need to keep in mind that affordability is one of a few different things that you need to balance, right? Do you want investment in, for example, reliability, right? And that's a huge deal that we've been talking about, particularly in the electric side, but also on the gas side recently, right? Do you want investment in reliability? Well, you're going to have to attract investment with a reasonable return, right? A reasonable return that is comparable, that investors will say, hey, I got my money over here in Missouri, but look at what Kansas is doing. Maybe we should look into Kansas and invest over there, right? Because investors are doing this. So again, this is not to say, oh, the moment you make a decision that's going to lower the ROE by 10 basis points, no investors are going to want to stay in Kansas. That's not to say that, but it is to say that there is a very clear and visible reaction from markets when certain decisions are made. And I don't know that every commissioner and every commission realizes that this is actually happening in real time.
Yeah, no,
Certainly,
that's great feedback. I definitely struggle with I know I understand the interrelationship between how the markets react after we make decisions, but then what's the tie-in, down the line in the utility's ability to fund and maintain operations by gathering capital. So and those are kind of separate things, at least in our world. So that's
they are.
very interesting.
They are. And the other insight that I got, and to be fair, this came from one conversation with one investor. I'm not sure that every other investor would agree. I would suggest that they probably think in the same ways, right? But one of the concerns for them is that commissioners tend to be short-term, right? The average lifespan of a commissioner in the US historically has been said that it's about 3 years. As you look at lately, it's been more like 2.5 years. And so for this investor specifically, he was very concerned that commissioners who are going to be on the commission for 2.5 years will put the short-term gains from lower rates before the long-term financial health of the utility. And that was something that was very clearly stated. And they're thinking about this, right? So if a commissioner comes in and they say, oh, we're going to lower the ROE to the minimum that we possibly can, and then that results in lower rates, sure. But then that results also in higher ROEs that are going to be needed in the future in order to maintain that financial integrity and those lower rates. So, as a commissioner, and I get this, I mean, again, I was testifying on this all the time for a commission, right? This is the balance that you're going to have to make. And it's a hard one. It's a hard decision. But I think it's important to keep in mind both the affordability aspect, but also the future investment aspect here.
I appreciate that. Thanks. You can tell you're not the only one that likes to geek out over this.
Fair enough. Fair enough. Next slide, please. All right, so this is the slide that I was talking about. I know that it's a little bit hard to tell, but you can see from the electric returns in blue and the gas returns in orange that there was space, there was air between those two lines to the left. And then as you move towards the right, that space kind of goes away, right? And in fact, for a little bit there, you see the gas ROEs are above the electric ROEs, and then they kind of meet again. This is what you're seeing. At the same time, I used the 30-year treasury bond in this slide. I could have used another measure of risk-free rate. But the 30-year Treasury bond yield was moving, right? And these allowed returns, these ROEs, are moving at a much slower pace, right? I'll talk about regulatory lag here, right? When interest rates go up, for example, sometimes commissioners who are looking at decisions at the time, they might think to themselves, well, are they going up for good, or is this like a blip in time? What's going to happen with interest rates in 3 months, 6 months? And so they wait. And so as interest rates change, ROEs tend to be slower to change with the interest rates, whether that's up or down. And so there's a lag associated with this. And then you can see that over time, commissions catch up a little bit, right? They might increase the ROE a little bit more in the future once they see that for sure interest rates are high and they're going to stay high for a little while, right? On the downside, no dig on commissioners who want to afford to ensure the rates are affordable, but they tend to be a little bit quicker on the trigger. So you see the reductions in ROEs to be a lot faster than the increases in ROEs as interest rates change. Next slide, please. So let's talk about the investor interview. So the first part we did was the foundational research. We looked at the data. We talked to investors about what we were seeing in the data. But here we're going to really dig into what investors told us directly. As I mentioned before, the ROE is a bottom-up process. So investors are not really involved, right? They don't want to get into the nitty-gritty of your straight line DCF or whatever. They just want to know what the ROE is and how that affects the risk in my portfolio. As I also mentioned, investors would testify previously. And they would say, here's what we're looking at. We don't see that anymore. However, I always encourage regulators to engage with investors. And I know that, for a lot of people, that might sound like it's not a great idea because it's investors. But at the end of the day, I think they're stakeholders that need to be heard. And so, for example, for years, both the Edison Electric Institute, but certainly the American Gas Association, has put together our investors with our regulators in conversations. The feedback that I've gotten from those, what we call New York trips to meet investors, has been tremendous, right? I think commissioners come with a different perspective on what it is that investors are looking for and how they look at the utilities in their states and how to invest their money. In fact, this week, precisely, it's our New York trip. We have 4 commissioners from 4 different states currently visiting with Moody's and with Fitch and with Mizuho and all of these investment firms, and kind of listening to the investors' concerns and telling them why their state is attractive and, all of these things. To the extent that you've never done something like this and to the extent that you can do it, I would really encourage you to think about it. It's a great opportunity to really look more into what investors really do want. So next slide. So the investor interview. So we started with a few areas of discussion. You can see them on the broad topic list there. We wanted to talk about generally regulatory matters, policy issues, the macroeconomic conditions that they're seeing, capital market positioning, their company-specific and stock selection strategies, and then other strategic issues that they could come up with. As we talked to them about this, they kept coming back to certain specific topics. And so what we did was we wrote them down and we kind of created a little bit of a heat map here where we talk about how many times these types of discussions came up, right? In that conversation, broadly. Now, obviously they might mention, for example, the allowed ROE in a sentence here or there, but we wanted to know when they actually, kind of expanded on their discussion of allowed ROE, earned versus allowed, all of these things. I was very happy to see that I did not waste my time for 15 years trying to figure out what the allowed ROE was, that investors really do care about it. They do care about their earned versus allowed ROE and all of these things. But, I want to show here generally the types of things that investors were really interested in this time around as we went through this exercise. There were changes to what we saw a number of years ago. For example, ESG used to be much bigger, and now it's slightly less important. Came up a lot less than it did 2 years ago. Same happened with gas bans. There was still a lot of discussion about gas bans, but not nearly as much as we had a number of years ago, because I think investors, and this is what we heard, they believe that gas, no matter how you cut it, is going to have to be a part of the solution. So all of these things, safety wildfires on the gas side, obviously, as you would expect, not a whole lot, right? Except to the idea that gas provides resiliency to the electric system, and therefore it needs to be thought in that general world. So those buckets that we started with resulted in 20 topic areas that we identified and we tallied to see how much interest there was in specific topics. So you can see this. What I would say is I encourage you to read the report. And I don't want to bore you with details about every single thing that we talked about, but I do encourage you to read the report. It's actually, I didn't write it, so I can say this. It was very well written. I did pay for someone to write it, and I was very, very happy to remunerate this person for his ability to write a very, very engaging, very good report. Next slide, please. So here are some of the insights, and these are going to be my last 2 slides today, and then happy to have a conversation about anything that was said today, and to the extent that it's within my bailiwick, I'm happy to talk about anything else that you might want with regards to this specific topic. But you know, the first thing that I'll bring up is that over time, conversations have become a lot more constructive between investors and the regulators and the utilities. And that was something that we were happy to hear. I think the regulators, the utilities, the investors, you know, they're still hearing about those gas bans, as I mentioned, but, you know, discussions about energy security, affordability, reliability, resilience, all of these things were a little bit more front and center when we talk to investors than things like gas bans. Now, investors' perspectives vary by region. We already talked about this, right? If you are a part of SPP, if you're vertically integrated, you know, if you don't have challenging geography, all of these things, you know, if you're not hit by hurricanes 3 or 4 times a year, you know, those things are going to be different. If you're not consistently talking about full electrification across your system versus a balanced approach, if you're not talking about, you know, building codes and standards being changed and all of these things. And investors look at all of these things, and they look at the risk that all of these conversations bring, and whether the ROEs that are being set in that specific jurisdiction are consistent with that risk appreciation that they bring to the table. So, you know, again, don't know much about Kansas other than I was there for like 3 nights, and it was a great time. And the steak was amazing. I don't know much about Kansas, but I do know that whatever Kansas specific risk profile is, investors are looking at it and they're expecting a return that's commensurate with that risk, whatever that may be.
Well, as a lifelong Kansan, I've never lived anywhere else. I will say my comment earlier about us being boring, you know, I certainly don't feel that way about the state. I was definitely talking about the regulatory perspective. I mean, from my perspective, this is a great slide, actually. I mean, we are a state that does allow below average ROEs in general, but also allow a lot of sort of your riders and surcharges and trackers, some by statute, some through the regulatory schemes. We've created programs to be transparent about which types of costs will be passed through those mechanisms, which I understand the investment community does appreciate that. So, you know, I think in that sense, you know, we're probably not a big gas ban state. So in all of those senses, I was saying we were boring, more in a easier to analyze our risk, I suppose, is what I meant. So glad you enjoyed the steak, though.
It was amazing.
My family are a family of beef producers, so I will pass that along.
Thank you. But, you would think that because of everything that you just said, it makes it easier for us to see the risk. It's still very difficult, right? It's still very difficult to measure. And, all we have is great analysts who look at these things and they try to tell what the best appropriate ROE is, right? At the end of the day, the best way to go about this, I've learned over time, is if someone has money in your state, right? You ask them, what is it that you need from us? And to be honest, utilities do this all the time, right? They meet with their own investors. The investors will tell them, this is what we're seeing. This is what we need from you. This is what we hope from you. And utilities will go out and say, here's the great plan that we've put together for you that I think shows that we're moving in that direction. And so I think from that perspective, the best approach is to really listen to the utilities and what they're hearing from the investors, because it's hard for investors to talk. And trust me, as someone who just went through this twice, getting them to talk was really, really hard, right? We had to go out and get some people who had real contacts. And, investors don't care about our money. You can't just be like, I'll give you $100 if you answer my questions, right? You really have to engage with them carefully. And so utilities are really, really good at doing this. They do this constantly. They talk to each other constantly, and they understand where they go. So that I want to highlight there. One of the things is as interest rates and bond yields rise, investors do expect, and as we've seen ROEs nationwide, they expect the ROEs to go up. And so they ascribe less downside risk on the allowed ROEs in that perspective. Mr. Gatewood.
Hi, I did enjoy your report. I think it is a pretty unique product, pretty unique perspective we don't see very often. What I'm curious about, what do investors talk about when they look at the gap between the allowed return and the earned return? Do they assess blame? Do they dig into the cause of that difference? What do you hear?
I don't know that investors honestly will sit and assign blame, right? What they will say is, this state is granting us these allowed ROEs, but then we're not able to see how this happened. And actually, I'll give you an example. Now, this is not a US example, right? This was a CGA AGA report. As I was presenting this report at NARUC in Anaheim, we had an investor-owned utility that had one of the biggest ones in Canada that has expanded into the US. And they brought up their ability to earn their return. That and the fact that in Canada, utilities tend to be over-leveraged as the reason why they expanded into the US and not along Canada. And they did this publicly, which was incredible to me, right? But they did this publicly. They got up in the middle of my presentation to presumably ask a question. But what they said is, we're happy to be in the US because in the US, on average, there's states and then there's states, right? But on average, we have seen that our ability to earn our return is higher. And that has allowed us to present a better product to our investors. Say to our investors, this is what we're doing to help us earn that return. So when you ask about investors specifically, I don't know that they care, right? They do this through the proxy of the utility. They'll say to the utility, hey, you're not earning your returns. And then the utility is going to have to create a plan to help earn those returns. And that's what you're going to see. I'm sorry, you're muted.
Oh, there we go. Kind of on the geekier side, I've noticed that beta coefficients for all utilities seem somewhat higher since COVID. Do you think that is an accurate reflection of the change in risk relative to the market for gas and electrics? Have you witnessed the same?
I have, although the change hasn't been long enough or big enough for me to be able to tell you whether this is a blip again or not a blip. I also don't know where you get your betas from, because for example, if you get them from Value Line, that's going to be different from like Zacks.
Right.
But
That's kind of what I've been trying to dig into, is the different calculation methods and sources and the length of time they use to calculate that number.
yeah. So they do it differently. I'm personally pretty partial, just from a purely academic perspective, to the way Zacks does it. I think it's more accurate, and it looks at the details a little bit more. Value Line is great, but Value Line is just like anything else, right? For example, growth rates by Value Line are amazing. But I think betas from Zacks are a little bit better in my perspective, the way they calculate them. And when you look at the Zacks betas, you see them slightly ticking up. Now, also remember that Professor Morin, he created that ECAPM methodology that some people use. And the whole reason why that happened was because of the regression to the mean that betas tend to do, right? And so, you'll always see the betas ticking up slightly, and then once a new decision is made, then those betas go back down. So I don't know in what position in the cycle we are. That's why we use the Bloom adjustments and all these other things to make sure that those things are in place, right?
Thank you. And apologies to the audience for having to talk about beta coefficients. So
Once we get into Bloom adjustments, man, we've gone down the deep end, but I'm here for it. I appreciate you asking that question.
thank you.
I want to focus a little bit on the fourth bullet here. I think we heard originally, and we heard it again this time around, a lot of ROEs matter. We need them to be set so that we can attract sufficient capital, but we need to be able to earn them. And again, I just answered that question, but this is where I was going to give my Canada example. But that really, really was hammered over and over and over again by investors. You need to show us how you've created an environment where we are allowed to a good opportunity to earn that return. Historically, if a utility is growing, it becomes harder to earn that return because you're growing, your costs are going up. I brought that up to the investors. I said, well, if they're growing, it makes it more challenging. But that works both ways, right? This is the argument that people will make. When you're not growing, then it'll make it easier. And what the investor said was, well, if you're not growing, then I don't care. So the only real scenario where I want to invest in a utility is if it's growing. And if it's growing, then you need to allow us that opportunity to earn that return. And I know it's going to be harder, but that's what we need. And so that was an insight from the investors. I just talked about the idea that Canadian utilities have been more highly leveraged than in the US. That has begun to change. It doesn't really matter for you guys specifically, but it is intriguing to see how, because Canadian utilities were highly leveraged and utilities started to leave for the US. Then in Canada, they've begun to become less leveraged for rate-making purposes, right? Which is ultimately what really drives these things. There was a discussion about performance incentive mechanisms. I think performance incentive mechanisms can be attractive if they're built correctly, not performance-based rates, right? And so, there was a discussion about how that can help incentivize policy objectives if you can institute them correctly. Next slide, please. We've seen a lot of movement towards private equity. What that means, I don't even know that the investors really know. But private equity is becoming a huge player in the utility sector. And we'll see where it goes. That's as much as I can say about private equity right now. It's become a much, much bigger proportion of investment in the utility sector. There was a lot of talk about meeting energy demand growth. This is where data centers and all that other stuff comes into play. And not only the ability to meet the demand growth, but the ability to meet the peak. Of note, the US energy system, the electric system, in the hottest day of the summer, delivers a third of what the gas system delivers in the winter. And this is so, as an average for the US, colder climates, that proportion is higher, right? So 3 times more energy delivered by the gas utility than the electric utility at its peak. And so there's a lot of things that can be thought of when we talk about that difference in peak. As you move towards higher energy demand than electric demand, for example, and that peak goes up. And the gas system serves as the primary source of peak shaving for the electric system in that particular point in time, right? And so this was actually brought up by investors, right? That you can't move that electric peak without also ensuring that the gas system is in place, gas to the home is in place to ensure that there is peak shaving happening. Now, this is what they see, and they're not energy experts, but I thought it was very telling that they're thinking about these types of things. As I mentioned before, ESG has become less a part of a conversation. I think it's more pragmatic. I think they care about affordability, reliability, resiliency as a separate thing from reliability, and how we plan for all of those things. We did see all study participants talking about an ongoing role for natural gas over a period of at least decades. And investors thinking that, electrification efforts are exerting big upward pressure on customer rates. And that will trickle down to gas. To what extent, we don't know, and they don't know. And then a lot of discussion about energy security, the idea that we are the #1 producer of natural gas in the world right now, the #1 exporter. We're certainly the #1 exporter to Europe. And so there was a lot of discussion about energy security, the future of gas with respect to that. So these are some of the investor interview insights, and I think that's all I had. So I'm happy to talk and to answer questions.
While I'm giving everybody a second to think of a question, let's go back to that last slide. You started to talk about sort of the interrelationship between the gas and electric systems. I think, your second bullet point there is that investors are intrigued. And I'm kind of curious, you told us AGA primarily is working on behalf of LDCs, and I'm sort of interested in, what are LDC investors thinking about the growth in natural gas as a fuel for the electric system? Obviously producers, that's a positive. That's huge demand for the commodity, but as a delivery company, and for growth of that delivery company for things like residential heating, is that seen as a competition that could potentially be negative, or is there a view on that, or is it truly just the word intrigued?
Well, I don't know that they have a specific view. I'll go back to what I said before, and that is the idea that direct use to the home, the way they see direct use to a home is as something that can help maintain reliability and resiliency on the energy system, or at least a number of the investors were talking about this specifically. Now, I have my perspectives. Happy to share them with you on a future date when we're talking, but this is what they brought up in the interview specifically, right? They were like, there's gonna be a need for peak shaving. You can't triple generation, transmission, distribution, and electric side. I hope that everything will be dandy, no matter how much gas you send to the power plants. If every single person is on the system, and a way to keep people off the system is through alternative fuels, natural gas being the more prevalent of them. So they actually see this as an opportunity for LDCs to kind of say, we're helping here with peak shaving. We want to be as sustainable as possible. But we are really here to provide affordability, resiliency during the most important times of the year, when it's brutally cold, and it's going to get colder next week.
We've all got our heat pumps on here in Kansas. All right. Is there anybody else in the audience, any commissioner questions or other questions from staff? Commissioner Keen, I see you've gone on camera. Go ahead.
All right, very good. Somehow I've lost focus on the group here. Let's try that again. Okay, Juan, thank you so much for this presentation. I think your presentation in focusing on investor perspectives and concerns, you're focusing on a part of the balancing proposition that I think we acknowledge as being important, but we need more nuanced information about. And I think you've certainly aided that process by helping to raise our level of awareness about investor perspectives. And I think that's very helpful. I think Jim Flaherty, he's on this call too. I think he would share that view without question. In terms of an investment environment, or an assessment of the investment environment in Kansas, I think the risk of a gas ban here is subliminal. But in terms of some of the last issues that you were touching on there, we have with natural gas, we have affordability, we have the opportunity for reliability across a wide variety of areas. But gas, as you have suggested, is an important national security issue. And I think that, frankly, that's been underappreciated. I believe that probably going forward, it will be more appreciated. But if I can just circle back with you to one of the initial points that you raised, I think it was back on the first slide. We need not bring it up, but basically it had to do with having innovative frameworks, I believe is how you had cast it, that reduce volatility. Kind of give us the overview of that now that you've given us the full-blown presentation.
Right. So the idea here is that, under what we will call the traditional regulatory process, right? And when I say traditional, I think I have to define that, right? What I'm talking about specifically is rate of return regulation under a fully historic test year, right? That's what we would call traditional rate making. In that world, right, you are recovering cost that has already been incurred a number of probably years back, right? Depending on your statutory time period and all of these things. And so if your utility is growing, you're always kind of playing catch up. So it also almost doesn't matter what ROE you give to the utility because they're never going to be able to make it because they're playing catch up, right? And so the idea is to create tools that will more effectively allow the utility to earn the cost, to get a return on that cost that they're incurring today. If that's impossible, then as soon in the past as possible, right? And so there's been many solutions to this problem and many solutions that affect different parts of the balance sheet and all these other things. But, forecasted test years, for example, is a way of doing that, right? Where you're trying to see what are our costs next year, or maybe in 2 years, or maybe in 3 years. Now, if most utilities have a pretty good idea of what they're going to invest their money in next year. And so you can pretty accurately be able to describe to, for example, your regulator, in this case, you, Commissioner Keene, here's why we're going to need to buy a couple more trucks. And this is like a main that we're going to have to replace and all of these things next year. And so what we would like is for you to tell us that we're going to be able to recover for that, right? Because we know that it's going to happen. Another way of doing this is by using things like multi-year plans where you set rates multiple years in the future so that, and that's good for everyone because, consumers know ahead of time the rate increases that are going to happen, but the utility knows with more certainty without having to come back for rate cases over and over and over and over again, what they're going to be able to be allowed to earn. And so all of these things, if you know more clearly what you're going to be able to be allowed to earn, then that reduces a little bit your quote unquote volatility. I call it risk, right? And investors appreciate that. Same thing with things like decoupling, right? We don't know how cold this winter is going to be. If it becomes super warm for whatever reason, right, compared to previous years, our revenues might really suffer, right? And we're not going to be able to make that return. So if you give some sort of decoupling, then maybe we're able to earn that return more accurately. And we can talk about all kinds of alternative forms of regulation. There's certainly rate design that fits under that bill, like things like straight fixed variable, where you actually recover the fixed cost through the fixed charge and the variable charge through the variable, the variable cost through the variable charge, as opposed to kind of loading the fixed cost or loading the variable charge. That also allows you to kind of like more accurately collect stuff. Surcharges, which Chairman French brought up, right? The more surcharges you have, those aren't subject to usage. And so because they aren't subject to usage, you are able to more adequately predict how much of that revenue is going to come into your utility. And therefore it makes it, again, quote unquote, less volatile, things like that. So, as you think about, the two things that go hand in hand, on the one hand is what is an appropriate return? That certainly is important, but also how can we work with the utility to allow them to earn this in a reasonable manner, right? If for commissions, and again, I don't want to cast aspersions. I don't want, whatever I say, if it sounds like Kansas, please don't think that I'm talking about Kansas because I don't know anything about Kansas. But if at some point, a commission was to say, hey, you know what? We gave them the allowed return. Good luck, utility. You figure it out. And there is no constructive work between the regulator and the utility to actually allow them to earn that return, then the investors are going to notice that. And as I said, if in extreme examples that we've seen the investors actually proactively react to that. So that's very important for them, is for you to work constructively with them to allow them to get that return, right? The allowed return is what you think the allowed return should be. And if you think that that's the appropriate return, then they should be allowed the opportunity to earn it. I think it boils down to that.
That's a great answer. I appreciate the nuanced aspects of it. In the ordinary course, and so many rate cases that we see come before us, certainly it applies to gas equally so with electric. We're dealing with the results of a settlement conference in many instances. So the die has somewhat been cast by the parties who were involved in that settlement process, the give and take, and the ultimate result that came about as a result of that give and take. So I'm presuming that the utility would represent the kinds of investor interests here that you're talking about in advancing many of the arguments they're going to make. I would like to think that our staff, and I believe it is, I think we have an outstanding first-rate staff in utilities. Very detail-oriented group and very knowledgeable group, and I think they're trying to be sensitive to the different aspects of that balancing proposition as well. But so often that's what we see. We see the results of that settlement process, and I presume that kind of process. How does the investor view the outcomes of those kinds of processes?
Well, that's actually a shockingly on point question, just because this is exactly what I'm starting to look at my work. I'm starting to look into the differences between settlements and fully litigated cases to see if I can see anything. I don't know that, I had the same question that you have. I looked, I searched, I didn't see any work that has actually looked critically at this particular point. And so I'm looking to see if there's an opportunity for me in my practice to look into that right now as we speak. That being said, from an investor perspective, I can't speak for the utilities in Kansas because I don't know. Certainly, if they agree to enter into a settlement, it is because whatever benefit they're getting from entering to that settlement outweighs the risk of fully litigating and maybe not getting something that they really want, right? So whether that also results in an ROE that they're comfortable with, I don't know. It could be that it is, but it also could be that they're willing to forego a little bit of an ROE simply because they're getting something else that they want. And those considerations come into play when you're planning and strategizing for settlements. And I think investors recognize that. I haven't talked about this with an investor specifically, but I have talked about it, for example, with S&P and the ratings people, and they certainly take that into account. And you see in their data They put a differentiation between orders that resulted from settled cases versus orders that resulted from fully litigated cases. And they weigh them differently. How they do that, I don't know, but they certainly weigh them differently.
Great answer. Thank you so much for doing this for us today. I serve on GEAR, the group within the task force within NARUC. We've had a lot of positive, really a result from the working relationship that we have with the AGA, and I just can't commend the AGA enough on that respect. It's really been focused on the critical missions that we're trying to accomplish and some of the results we're trying to bring about. Thank you so much for your efforts.
Well, thank you, Commissioner Keene, first of all, for participating. We need more people to participate, not less. We need more people to be engaged and be proactive and productive in these conversations. I was in Atlanta last month when you were there, and we saw these conversations happening. And there were great conversations, I think. And I will tell the folks here at AGA who actually plan and run these things, which are not me, that your thoughts, and I really, really want to thank you on their behalf for those kind words. I really appreciate it.
Well, from the leadership of the AGA to, I think, some of the implementation here that happened through Kimberly, she was extremely helpful in what she did. I thought what they came up with. I'm hoping, and I think we may soon have future communication with the AGA to try to encourage repetitions of this Atlanta forum in the future, and kind of working toward that, because I think it was very beneficial. Thanks again.
Thank you.
All right. Are there any final questions or comments from the other participants in the workshop? I see a couple people going on camera.
Yeah, we'll go with Kat and let her give the thank you.
All right, go ahead.
Good afternoon, Chair and Commissioners. Kathleen O'Connor with Atmos Energy. I just had some kind of closing remarks. Just wanted to mention that, we would like to continue to use these workshops to share information with the Commission and the general public about other issues that are going on within the natural gas utility. So again, just thank you again, and appreciate your time today.
Yep. Thank you all for your
Mr.
time.
Christian. Mr. Christian, did you have any final comments?
No, just the thank you again for the opportunity. I know this is just exactly what we're looking for, and I know Commissioner Keene's earlier comments about this is just a small piece of the pie, but there's a lot bigger pie, and we're just looking at one little piece of it today, and glad we had the opportunity to give you all a little bit more information on that, and do appreciate Juan's time showing up for the association for us.
All right, very good. Well, thank you for everyone's participation, but yes, special thank you to Mr. Alvarado. We really appreciated your presentation. It's good to have these opportunities to get together and ask questions in a different kind of setting than we always have to get together. Appreciate this little more informal view on things. So thank you for your time, Mr. Alvarado, and for everybody. If there is nothing further, and I'm not seeing any waving hands, I think I will go ahead and conclude this work study session. We are adjourned. Thank you all. Take care.
Thank you, everyone.